Our next guest says that he expects a 50 basis point hike, and joining us is Jason Furman. Of course, he was the chairman of the White House Council of Economic Advisors under President Obama. He's now an economics professor at Harvard's Kennedy School of Government. And Jason, before we get to what the Fed's going to do, I want to back it up a little bit. I've been thinking an awful lot about inflation yesterday and today. Just everybody's blaming everybody else for it. You can say it's because of wages going up, that it's now really embedded into the economy and it's going to be hard to get rid of. We had a labor leader on earlier this morning who said it's big corporations' fault because they keep raising prices. But really, you got to go back to Milton Friedman. He says it's Washington. Inflation always originates and comes from Washington. And we spent trillions of dollars during COVID, and the Fed left rates low for a very long time. What else did we think was going to happen?
Yeah, I certainly agree with that diagnosis. And you always try to tell individual stories around inflation. But what inflation is upward pressure on everything. You see it on prices, you see it on wages. And when it comes to the private economy, by the way, it's not a morality play. If a business has a lot of customers that show up, they're going to raise their prices. If businesses really want to hire workers, workers are going to, increase their wages. That's just the way the economy functions. And then you have to ask, why is it doing that? Ultimately, it's really the government and ultimately the Fed's responsibility.
So it's too much demand for too little supply. I mean, the other question people keep asking is it different this time than it was in the 1970s? Is it different because we have all kinds of issues like a shortage of labor? We don't have the right immigration policies here. We have all kinds of problems with the supply chain. Can it be fixed this time with the Fed's tools?
It's always a little bit different, but it's pretty dangerous to go out there and say, we've seen something happen 6 times before in a certain way. For example, you can't bring inflation down without unemployment up. You can't see job openings and quits come down without unemployment going up. We've never, ever, ever seen that before, but we're about to see it this time. I do think anything's possible. I think a soft landing is possible. I agree with that. I just don't think it's the most probable outcome for next year. And, there's only so far your excuses take you. A year and a half ago, the economy was really scrambled by the pandemic. Now the labor market, as Chair Powell said at Brookings, it sort of is where it is. Maybe it's the fault of lack of immigration. We're not going to get a lot of immigrants in the next year. I wish we would, but we're not going to. So they have to go to war with the economy that they have, not the economy they wish they had.
So you think the Fed is only going to raise by 50 basis points, but you think it's going to be a hawkish 50 basis points, I guess, because of what they're going to say around it?
Exactly. I mean, look at, they did 75 in July, and that was a dovish 75. The market experienced relief up until Jay Powell dashed it at Jackson Hole. We've seen a big easing of financial conditions. I think some of that is warranted. Some of the data that's come in, like the productivity numbers yesterday, were a little bit optimistic in terms of unit labor cost growth being lower. Some of the other data that's come in has been really pessimistic. The large upward revisions to wage growth in September and October, for me, were sort of an aha moment that made me much more worried. So I think the Fed is probably nervous about how easy financial conditions have gotten. In a sense, there's been a 50 basis point easing since October. And I don't think they're going to want to see more of that. So they say do 50 at this meeting, but leave on the table, a string of 50s after this, if that's necessary.
And I guess the bigger question is, what's the terminal rate? Is 5% the number? Is it going to be higher than that?
Look, if I had to do my best guess, I would say 5 or 5.25. But where I, sometimes worry is I think a number over 6 is completely conceivable. If we're seeing inflation, in the 4s next year, they're going to keep going. Maybe it's even just 25 basis points a meeting. That'll take them above 6. That's not my best guess, but markets really need to be prepared for that. The other thing markets need to be prepared for is it may not be once and done. We may have an incomplete hard landing where we have a bit of a recession, we have inflation come down, but it comes down to something like 3.5. And then the Fed needs to sort of do another tightening cycle to get that inflation down further.